For the first time, actively managed ETF assets have reached $1 trillion. It's about 10% of all ETF assets right now. That's a big milestone. I want to talk about this with the head of ETFs for one of the biggest active managers out there. Tim Coyne is the head of ETFs for T. Rowe Price. Also joining us, my old friend Todd Sohn, head of ETFs for Strategas and an all-around ETF maven in general. Tim, T. Rowe Price, known for its active management ETFs. Can active management really make a difference with all this market turbulence?
Yeah, absolutely. And we have seen significant growth in active management, including active ETFs, which I think has been a significant driver. It's really combining the key attributes of actively managed portfolios with the benefits of ETFs and delivering in a lower cost, more tax efficient structure for investors. But I think also if you look at just the markets in general have changed. And I think having that professionally managed portfolio is really beneficial to clients. And we're seeing greater volatility, uncertainty across both the equity and fixed income markets as well.
Yeah, Todd, market turbulence has been good for active flows. You've been writing about this for a while. 30% of ETF volume so far this year has been active.
Yeah, I think when you get into a different environment rather than one that's persistently rising, this is where active comes into hand. You have a manager who can differentiate the portfolio from the top 10 stocks in the S&P 500, which were coming off the boil in terms of influence, or you can have a manager who's out there looking for income or managing risk through options, right? This active comes in many spades now.
Yeah.
And I think this is the type of environment where it can actually shine, as painful as it might be for a lot of passive holders out there because we are in some form of bear market. This is where the active manager really can come into hand and offer their solution they are doing, right? Differentiation, equity, or managing risk through derivatives.
Yeah. Now, we always throw this caveat in when we talk about active. The old school idea of active, like real active stock picking, which what you're doing actually, some of these, active is very broad. It includes people, like Avantis, which are sort of indexing plus. They're active, but it's really S&P 500 with an overlay of a value screen, maybe a small cap screen on top of that.
Right.
Old school stock picking is still relatively small percentage of it, although here you're doing it in yours, obviously to a certain extent. So I just want to make that differentiation. Everybody says all of a sudden the world's decided to buy into stock picking. That's not exactly the case. It's still a pretty small amount of the flows.
There will be environments where a star manager has their moment, depending specifically on what is going on in the cycle. But there are also going to be managers such as at T. Rowe who are much more consistent in their methodology, and maybe they don't blow the doors off coming off of a low, but you're going to have much more persistent and consistent returns along with lower volatility. I think that's really important.
I think so. Let's talk about that. So you big inflows into your capital appreciation ETF. This fund is still big believer in big cap tech stocks. You've got holdings like Microsoft, Amazon, Nvidia, and Apple. That's about 25% of the fund's holdings. But you've also got smaller names. I think Becton Dickinson's in there and Roper. What's the idea behind this fund? This is real old school picking. What are you doing here?
Yeah, this fund is designed for long-term growth. And the objective of the fund is to outperform the S&P 500 with lower volatility and greater tax efficiency through the ETF. It's also a more concentrated portfolio, typically holding around 100 names. And this is really driven by T. Rowe Price, and to Todd's point, I think there is differences in active management, and T. Rowe Price as a firm, we have over 1,300 investment professionals globally, 350 plus are research analysts. So we perform rigorous bottom-up fundamental
So what are you trying to do with capital appreciation? Because I mean, look, the 25% is Microsoft, Amazon, Nvidia, and Apple, but then, as I mentioned, I see Becton Dickinson's 4%, Roper's 3%. What are you trying to do? Here's the biggest holdings here. We like to do this just to show you what's going on, but is there a general philosophy here?
Yeah, as I mentioned, the philosophy is to outperform the S&P 500 with a more concentrated portfolio, so high conviction stocks that are driven by the investment research team. And this fund is managed by David Giroux, who is also two-time Morningstar Manager of the Year. 6 times he's been nominated for that. So he and his team are very skilled and very experienced, and this is the portfolio. He also has a complete franchise across mutual funds and now ETFs. So this is a new way for our clients to get exposure to this strategy via the ETF.
You came into the ETF space a few years ago, right? You're relatively late because you're so traditionally into that active space.
Yeah, me personally a long time ago, but as a firm,
you've been around, right? Yeah.
As a firm, we launched our first active products in 2020.
Yeah,
our first ETFs.
And you've got a second big cap ETF. I just want to bring up here, Equity Research. That's TSPA. It's got an even bigger weighting in tech. About a third of it is the top six names: Apple, Microsoft, NVIDIA, Amazon, Alphabet, and Meta. How does this differ from capital appreciation, this one?
Yeah, this is more of a large cap growth product that it does have lower tracking to the index. So there are components of characteristics of both passive and active here. This fund is actually managed by our North American Directors of Research. So again, strong fundamental research that is going into the stock selection. So we may be overweight certain securities in the index that we have a favorable rating on, or underweight or avoid certain securities in the S&P 500 that we don't feel great about the fundamentals of those companies.